Welcome back to Mind Portfolio Lab. In the first video, I introduced the channel and explained that this is a record of my development as a systematic Forex trader using Darwinex 0. In this video, I want to explain one of the main ideas behind the portfolio. Why is it built around multiple EAs rather than one single trading system? This is an important point because the portfolio is not based around the idea that there's one perfect EA that works in all market conditions. In my view, that's not realistic. Every strategy has strengths and weaknesses. Every strategy has market conditions where it performs well and market conditions where it struggles. A breakout strategy might perform well when the market has momentum, but struggle when price chops around the level. A reversal or pullback strategy might work well when price overextends and comes back, but struggle in a strong one-way trend. A session-based strategy might perform well when there is regular intraday behavior, but less well when volatility changes or the market becomes erratic. So the aim of this portfolio is not to find one perfect system. The aim is to combine different systems that are designed to capture different types of market behavior. At the moment, the portfolio is made up of several EAs. Each one has its own logic, its own trade frequency, its own holding times, and its own strengths and weaknesses. Some of the systems are built around daily price patterns or continuation behavior. Some are more focused on breakout style moves. Some look at previous day levels. Some use pullback or reversal type logic. Some are more short term, while others may hold trades for longer. That variety matters because I do not want the whole portfolio depending on one single idea. If the EA was basically doing the same thing, on the same pair, at the same time, then it would not really be a diversified portfolio. It would just be the same risk repeated several times. A portfolio can look diversified on paper, but if all the systems lose in the same conditions, the risk is still concentrated. So one of the things I care about is whether the strategies are genuinely different from each other, not just different names, but different behaviors. Do they trade different setups? Do they respond to different market conditions? Do they hold trades for different lengths of time? Do they perform differently during trend, range, volatility, or quiet periods? And importantly, do they all suffer at the same time? That is the part that matters at the portfolio level. The individual backtests for the systems are encouraging, but I don't treat a backtest as proof that the portfolio will perform the same way live. Backtests are useful. They help show whether an idea has worked historically, whether the rules are coherent, and whether the strategy has produced enough trades to be worth monitoring. But a backtest is only part of the picture. The real question is how the portfolio behaves in a live, verified environment over time. That's one of the reasons I'm using Darwinex 0. It gives me a structured way to develop and monitor a track record. It also forces me to think less about individual trades and more about the overall portfolio behavior. For me, the main question is not, did this trade win? The better question is the portfolio behaving broadly as expected? That means looking at things like drawdown, trade frequency, holding time, whether the systems are becoming too correlated, whether the losses are within normal range, and whether the live results are broadly matching the type of behavior seen in testing. It also means accepting that some EAs will have quiet periods. A system does not need to win every week to have a role in the portfolio. In fact, judging an EA on a handful of trades can be misleading. Some strategies need a much larger sample before you can make a fair judgment. One EA might have a high win rate, but smaller average wins. Another might lose more often, but make more when it does catch the right move. Another might trade frequently with smaller positions, while another trades less often but holds for longer. Those differences are not a problem. They're part of the reason for combining them. The aim is not for every EA to look the same. The aim is for each one to have a clearer role. At a sample level, I think about the portfolio in terms of components. One component is designed around daily pattern and continuation behavior. Another focuses more on short side pattern opportunities. Another looks at daily volatility or mean reversion style behavior. Another is more short-term and momentum based. Another is built around day open or intraday continuation behavior. Another uses previous day high and low breakout logic. Another looks at breakout and retest style behaviour, and another uses stochastic and engulfing confirmation to identify potential entries. I'm deliberately keeping that at a high level. I won't be sharing the exact code, settings or entry rules. The point of this channel is not to give away the systems or provide trade signals. The point is to document the structure of the portfolio and explain how I think about the system as a whole. The important thing is that these EAs are not all trying to do the same job. Some are designed to capture momentum, some capture breakouts, some looking for continuation, some are looking for reactions around certain levels, some are more sensitive to time of day or session behavior, some may be more exposed to overnight or weekend holding. The last point is important too. Holding time is part of risk. A system that holds trades for minutes or hours has a different risk profile from a system that can hold for days. Neither is automatically better or worse, but they need to be understood differently. Longer holds may capture larger moves, but they can also be exposed to gaps, weekend risk, news, swaps, and changes in market conditions while the trade is open. Shorter term systems may reduce some of that exposure, but they can be more affected by spread, execution, noise, and frequent false signals. So when I look at the portfolio, I'm not only looking at profit or loss, I'm also looking at where that profit or loss is coming from. Is the performance being driven by one EA, or is it spread across the portfolio? Are several systems taking similar trades at the same time? Are the losses clustered around the same market conditions? Is one system adding too much exposure? Is the system behaving differently live compared to how it behaved in testing? Those are the types of questions I want to keep asking as the portfolio develops. This is also why I want to avoid constantly interfering. With automated trading, there's always a temptation to step in, to close a trade early, to turn something off after a loss, to increase risk after a good run, to make emotional changes based on a short period of performance. But if the systems have been designed and tested properly, then part of the discipline is allowing them enough time to show whether they're still behaving within expected limits. That does not mean ignoring problems. If something is clearly broken or behaving in a way that does not match the logic or the strategy, then it has to be reviewed. But there is a difference between reviewing a system properly and reacting emotionally to normal drawdown. This is one of the reasons I want to document this process. It gives me a clearer framework for thinking about the portfolio. It also creates a record of what each system is meant to do, what I expect from it, and what I'm monitoring over time. The backtests are strong enough to justify monitoring the portfolio seriously, but the live phase is where the real evidence is built. So at this stage, I'm not trying to present this as a finished or proven product. I am documenting a systematic Forex portfolio in development. The individual systems have encouraging historical results, but the focus is now on whether the overall portfolio can behave consistently in a verified live environment. That's the real test. In the next videos, I'll start going through the individual EAs one by one. I will explain the general idea behind each system, what type of market behavior it's designed to capture, what conditions may suit it, what conditions may make it struggle, and why it has a place in the wider portfolio. I will keep the explanations high level. I won't be sharing any code, exact settings or trade signals. The aim is to explain the role of each EA within the portfolio, not to encourage anyone to copy trades or follow the system blindly. So the key point from this video is simple. The portfolio is not built around one perfect EA. It's built around combining several different systems, each with a defined role, and then monitoring how they behave together over time. The aim is not to remove risk, that's impossible. The aim is to understand the risk, spread it across different sources of return, and build a track record that can be judged properly over time. That's what I'll be documenting on this channel. Just process, risk, and the results they develop.